With the short time remaining, I've picked an opportunity from each of our funds and done a bit of a case study. And I'll start with our Canadian Income Fund. That fund, as Wayman mentioned, is in excess of $700 million in gross asset value. And this property is in Metro Vancouver. It's a retail power shopping center. And we acquired this in the spring of 2013. The reason we liked this deal was it had great street presence off the Trans-Canada Highway and a great location, but it had HomeSense, Canadian Western Bank, and the Cactus Club. But we also knew there was a couple things we had to do when we acquired the asset. It had some tenants that we knew weren't going to make it for the long term. It also had an existing mortgage on the property that still had another year and a bit to run, and the penalty to pay it out was $1 million. So we decided, let's assume that mortgage and we'll fix the property up and we'll finance after. So fast forward, we were able to reposition Bowring and Bombay, moved out the weaker tenants, and we were able to land Winners, which is a subsid of HomeSense. Now the center is fully leased again, but on a much more stable basis. We're also able to, and of course we planned this, finance at much lower interest rates than we had done in our underwriting. So the result is we have a great asset, fully leased for the foreseeable future with a terrific IRR for our investors. The next example is our U.S. Income Fund, and as I mentioned earlier, this is over $900 million in gross asset value. We acquired this in the late 2012, and as many of you probably recall, the U.S. economy was still in recovery mode and was just starting to gather steam. Now, at the time, if you remember, we started the U.S. fund in 2010, and a lot of it were assets in Seattle. We liked Seattle. It was easy. It was close to Vancouver, where we're based from, and we were building up a nice portfolio. But we wanted to diversify, and we knew San Francisco was a place that we wanted to get to. We were following the tech market closely. We knew it was exploding. So these two assets, they're creative office buildings, which means they were suited for tech tenants. We liked it because the rents were under market. Market was around 35 per square foot and growing fast. Our rents in place were 25. It was also right, you can't see from this picture, but it was right across the street from the new Transbay Terminal in downtown San Francisco, which is a $1 billion infrastructure project, which is now just completing. So we liked the location. We knew the rents were under market in case the market went the other way. So fast forward, we actually completed the planned capital projects for the properties, even though they were already improved. They're actually our oldest properties in our portfolio with the highest rents. We now are getting over $75. I mean, that's how crazy the market is in San Francisco. This asset has been one of the best performing in our portfolio. It's very difficult now for us we missed that market to buy more. In hindsight, we should have bought everything in that market, but it's too difficult to make the numbers work. But we're happy with this. It gives us a presence in that marketplace. That was the increase in value. Okay, the third fund is the one that I'm most excited about, is the value add. And Wayman and I have been talking about this for a few years with John, saying the people who are really making money in the marketplace are creating the value. And so it was just a matter of finding the right partner. And the value add fund it's a pure merchant fund. Everything we do in it, whether we're repositioning an existing property or building from the ground up, we are selling. It's a pooled fund, but all the projects turn in that fund. And in order to execute the strategy, we need to partner with skilled developers on the front line. So we the first 3 projects are with PC Urban, great partner in Vancouver. This is actually the 3rd project we're doing with them. We've got 3 more we're doing, so we'll be on to 4, 5, and 6. This property is a 5-acre site, and for those who are familiar with Vancouver, it's in Marine Drive as you're going to the airport. People are shocked at what we paid for the land. We paid $10.5 million, which is over $2 million an acre. What we decided to do, we did research and we felt that there was a strong demand for small bay industrial condo, small bay being 2,500 to 3,000 square feet. It had been built 15 years ago, but nothing had been built since, and there was no inventory. Our partner, PC Urban, had actually done a smaller version in North Vancouver, so right away we knew that there was demand. So Wayman doesn't even know this, but as of today, we're actually 90% pre-sold. We thought we were going to sell it at $290 a square foot. We're actually up to $320 a square foot. There's 3 phases. We thought we were going to build it and be conservative in three separate stages. Because we're 90% pre-sold, we're starting construction this month, and we're going to build it all at once. So the IRR on this investment is going to be a lot better than our underwriting. The users that are going into this, again, we didn't know how this project was going to turn out. We didn't know if it's going to be investors or owner users, and what really was interesting to see the profile of the buyers. Some bought 1 unit, some bought multiple units. They were owner users of businesses. They would sell their old crappy real estate and make a lot of money because it's in the path of development, and then we buy something new that's modern, that more suits their business, put money in their pocket, and the price point worked for them. As I mentioned a minute ago, the value add fund is what we're having the most fun with, and working with PC Urban as an example. One of the things that we've been able to do successfully is get some terrific marketing exposure in both local media and national press. And that has helped create a lot of energy and excitement from users, which has helped in the success of all our value add projects. And it also has helped create a lot of interest from the brokerage community, who we rely on to bring us deals. Our approach to real estate, one of the things we're proud of is that it's very diversified by asset class and geography. We are just focused on major markets. And the real work begins when you buy the asset. I mean, there's a lot of work that goes into the underwriting and the due diligence and the financing, but after you buy it, that's when you find out about your property. And we're very fortunate to have a very skilled team of asset managers who their job is to work and make sure the capital projects proceed and they grow the revenue. And with that, we are very proactive on our leasing and capital strategies. We don't want to wait till it's too late. It's amazing how many properties are mismanaged in real estate, so we always try and stay ahead of the curve. As Wayman mentioned earlier, we are very conservative in our debt. What we typically do for our income funds is we will finance 60 to 65% of the commercial properties, loan to value, and they're typically, if we're buying at a 6+ yield, going in yield, we're trying to have a 250 to 300 basis point spread, and that helps us give our leveraged IRR in the high single digit to low double digit figure. Another important part of growing our portfolio is partnering with best-in-class operators. We're still going to buy properties 100% on our own, but we know to scale up that we need to partner who can open up more opportunities for us, and that's worked out well. We have many valued partners that Wayman's already addressed. And the last thing is we have a very disciplined approach. It's an extremely competitive environment trying to source opportunities in the marketplace. We're very conservative in our underwriting because we want to make sure that we have a 12-year track record we want to maintain. So just to conclude, we're very proud of the portfolio that we've built. It's $2 billion, 100 properties, and 10 million square feet. As Wayman mentioned, Toronto is a strong priority. We have 2 commercial assets here. I am coming here a lot, so I'm getting my air miles. We are committed to this marketplace. It's when you look at the map in Canada, with Alberta on the pause, it's really Vancouver and Toronto. Those are the major markets. So we are spending a lot of time here, and I'm hoping that the next year when we're here, we will be able to tell you about the new exciting properties we've acquired. Thank you for your time.